Hi, I'm going to talk about portfolio credit risk, and we are going to do a quick revision of what we were doing the last time. So, a major drawback of using the default correlation based portfolio framework, where we try to calculate the correlation between different portfolios and the probability that everything would default or both of them would default. So the problem with that is the number of required calculation, and also to specify all possible outcomes in the event we require three individual firm default output probabilities, two default probabilities and three outcome probabilities. Then there is no default outcome probability. Thus, in case of 2 to the power n events, outcome will be n plus 1 plus n into n minus 1 by 2. That's again the combination formula. Thus, 2 to the power n event outcome would go very high. So, example, if we have 10 firms, then we will have 1024 events with around 56 conditions. The number of pairwise correlation is equal to n into n plus 1. So, in modeling credit risk, the pairwise correlation are often set to a single or non-negative parameter. This is very similar to the portfolio risk that comes into CFA level 2, where we assume everything is same and we simplified the calculation. Now, in addition, certain characteristics of credit portfolio do not fit well in the default correlation credit portfolio model. Guarantees, revolving credit agreement and other contingent liabilities have features similar to options, and that do not reflect, that cannot be reflected in the simplistic calculation. For example, credit default swap basis trade may not be modeled simply by credit or market risk. Rather, technical factors may play a role, as was evident in subprime mortgage crisis when there was lack of liquidity. Furthermore, convertible bonds have characteristics of credit and equity portfolio driven by market and credit risk. Additionally, drawback in using the default correlation based equity credit portfolio framework are related to limited area of estimating defaults. Firm defaults are relatively rare events, therefore estimated correlation vary greatly depending on time horizons and industry. Most studies use an estimate of 0.05. Thus, default correlations are small in magnitude and joint probability of two firms is even smaller. Now let's look at credit war. Assess the effects of correlation on credit portfolio and credit war. The effect of default correlation, and loss given default are important determinants in measuring credit default risk. A portfolio credit value at risk is defined as the quantile of credit loss expected less the expected loss of the portfolio. Default correlation impacts volatility and extreme volatility of loss rather than expected loss. Thus, default correlation affects a portfolio's credit war. If the default correlation is 1, then there are no credit diversification benefits and the portfolio behaves as if there were just one credit position. A default correlation equals to 0 implies that the portfolio is binomial distributed random variable because there is no correlation with other firms and credits. Now let's understand an example where we compute credit war, where the default correlation is 1 and the number of credits is n. So suppose there is a portfolio with value of 1 million and has got n credits. Each of the credit has a default probability of pi% and a recovery rate of 0. This implies that in the event of default, total position will be at a loss. Now what is the extreme loss given that? Loss given default and credit war at 95 percentile level if pi or probability, default probability is 2% and default correlation equal to 1. So if the default correlation is 1, the portfolio will act as if there is only one credit. Viewing the portfolio as a binomial distributed random variable, there are two possible outcomes for a portfolio acting as 1. Regardless of whether the number of credit in the portfolio is n, which is 1, 20 or 1000, it will still act as one credit where the correlation is 1. The probability, the portfolio has a pi% probability of total loss and 1 minus pi probability of 0 loss. Therefore, with a recovery rate of 0, the extreme loss is 1 million. The expected loss is equal to portfolio value times pi. And in this case, it's 20,000, which is pi into 1 million. The 98% probability of that loss will be 0, given that pi is equal to 2%. The credit war is defined as the quantile of credit loss minus the expected loss of the portfolio. Therefore, 95% confidence interval level, the credit war is equal to minus 20. Note, if pi was greater than 1 minus confidence level, then credit war would have been calculated as 1000 minus 20,000. Now moving ahead to the next example, computing VOR. If the default correlation is 0 and number of credits is 50. So again, suppose we have 1 million portfolio with n credits and each have a default probability of n% and a 0 recovery rate. However, in this example, the default correlation is 0, n equal to 50 and pi or probability of default is 0.20. In addition, each credit has equally weighted and has a terminal value of 20,000 if there is no default. Now the number of default is binomially distributed with n is equal to 50 and probability of default is equal to the 95 percentile default based on this distribution is 3, and what is the VOR portfolio at 95% confidence level based on these parameters. The expected loss in this case is 20,000 into 1 million into 0.2. There are 3 defaults. The credit loss is 60,000. The credit VOR at 95% confidence is 40,000, which is taken by taking the credit loss of 60,000 and subtracting the expected loss of 20,000. So now we have to always subtract the expected loss from the credit loss to find out the credit VOR. Now we move to the heading here, the credit VOR. The term granular refers to reducing the weight of each credit as a proportion of the total portfolio by increasing the number of credit. As a credit portfolio becomes more granular, the credit VOR decreases. However, when the default probability is low, the credit VOR is not impacted as much as the portfolio becomes granular. So if the default correlation is 0 and the number of credits is 1000 and everything is same, like probability is equal to 2%, 0% recovery, and then there is a probability of 20 default at 95 percentile binomial distribution with n is equal to 1000 and pi equal to 0.2. What is the credit VOR at 95% confidence level based on this level? Now the 95 percentile credit loss distribution is 28,000 into 28 into 1000, 1 million divided by 1000. The expected loss in this case is 20,000 and the credit VOR is equal to 8,000, which is 28,000 minus 20,000. So we get this 28,000 from the values given to us that there is a probability of 28 defaults, and the probability of 28 defaults means 28 people not giving us money, and there were 1000 credits. So we find out the credits, we multiply it by 28, and these 28 was like the total loss. So that was happening, and we subtract it from the expected loss. So we have an expected loss that something like this would happen, but 28 loss means we are going to lose 28 positions, and we subtract that to get credit VOR. So thus, as the credit portfolio become more granular, the credit VOR decreases. For very large credit portfolio with large number of independent credit files, the probability of credit loss equals the expected loss converges to 100%. So even if you don't get the quant here, you have to understand a few things. The first thing is that the expected loss is directly 2% into 1 million, or the probability of default into the total amount. The second thing that you need to understand is that if you are losing some position completely, then you don't get any money out of that. So that position you have to make it to 0, and they'll give you that at 95 percentile you are losing this many positions. And the third thing is, as you increase this position or credits or number of portfolios here, the loss or the probability of credit loss equal to expected loss. Now moving ahead, conditional default probability. Describe how a single factor model can be used to measure conditional default probability given economic health. The single factor model is used to examine the impact of varying default correlations based on credit portfolios beta. Each individual firm I has a beta correlation B with the market. The individual asset return is alpha 1 into beta 1 into 1 minus beta square into EI. Now there are two things here. We have the firm's standard deviation of idiosyncratic risk, and that standard deviation has to be multiplied by firm's idiosyncratic shock random number to get the firm's return. Now assuming that EI are not correlated with other asset, each asset has AI, that is their return is the standard normal variate. The correlation between pair of individual assets is I and J is BI BJ. The model assumes I default if AI is smaller than KI. The logarithmic distance to default asset value is measured by standard deviation. An important property of a single factor model is conditional independence. Conditional independence states that one asset return for the market are realized, the default risks are independent of each other. This is due to the assumption that for single factor model, that return risk of an asset are correlated only with market factors. The property of conditional independence makes single factor model useful in estimating portfolio credit risk. So how can single factor model used to measure default probabilities? that are conditional on market movements or economic health. Suppose the market factor M has a specific value of M bar. Substituting this M bar into equation 2 and subtracting BI M bar from both sides, it will be equation 3. The default risk is measured by distance to default, that is AI into BI into M bar. The distance to default either decreases or decreases. The only random parameter is the idiosyncratic shock. So we subtract A minus BI into M. So return minus the market return into beta, and we find out how much far is this from the standard deviation. So that is 1 minus beta square into EI. So as a result of this conditioning, the default distribution mean shift based on the specific market value beta, and that is greater than 0. The default threshold KO does not change, but the standard deviation of default total is reduced to 1 minus beta I square. The unconditional default distribution is a standard normal distribution. However, the conditional distribution is a normal distribution with a mean of beta M and a standard deviation of 1 minus beta I square. Specifying a specific value of M bar from the market parameter M in a single factor model results in the following implication, and we have three important implications here. The conditional probability of default will be greater or smaller than the unconditional probability of default as long as M bar or B bar are not equal to 0. This reduces the default triggers or the number of idiosyncratic shocks EI, so it is less than or equal to KI minus beta IM. As the market factor goes from strong to weak economic, small idiosyncratic shock will trigger default. A conditional standard deviation of 1 minus beta square is less than the unconditional standard deviation of 1. Individual asset return AI and idiosyncratic shock EI1 are independent from the firm shocks and return. Now we have conditional default variance. Compute the variance of the conditional default distribution and the conditional probability of default using single factor model. Suppose a firm beta I is equal to 0.5. The default threshold Ki is equal to minus 2.33. The unconditional probability of default is 1%. If the market returns are minus 0.5, what is the unconditional variance of the default distribution using single factor model? If we recall that phi represents a standard normal distribution, if you see that in the book. The unconditional distribution is a normal distribution with a mean of beta I into M bar and a conditional variance of 1 minus beta I square. For this example, the mean is beta I into M, which is 0.5 into minus 0.5 is equal to minus 0.25, and the conditional variance is 1 minus 0.5 square, which is 0.75. The conditional standard deviation is then 0.866, which is the square root of conditional variance. Now the conditional cumulative probability of default as a function of M is phi of k minus beta I M upon 1 minus beta I square. This is the new distance to default based on the realized factor beta I M, and the standard deviation assumes conditional independence and is equivalent to 1 minus beta I square. Thus, given a realized market factor M bar, the probability of default is based on distance to new default trigger of idiosyncratic shock EI measures as the standard deviation and its mean of 0. So let me make this simpler for you. Now we are saying that the distance to default of a firm is dependent on the return of the market. So we are linking everything with the market. And we are saying that we have first calculated the beta, which is the sensitivity of the return to market, and then we use that to find out the firm's return, which is then used to find out the distance to default. Now to do that, we use various things. We use inputs. We use the shock, the firm's idiosyncratic shock, and its standard deviation of idiosyncratic risk. So we use these two parameters to find out. So we need to look at how market affects the shock and which shocks are independent of which. So I'm repeating the 3 points for you. The conditional probability of default will be greater or smaller than the unconditional probability of default as long as M bar or BI are not equal to 0. This reduces the default triggers or the number of idiosyncratic risk EI so that less than or equal to KI minus beta IM. As far as the market factor goes out strong to weak economy, a smaller idiostrong would prefer default. So if the market conditions are going bad, then we'll see that the chances of default increases, and that's what they are trying to include here. So I'll move ahead, and the next heading here is explain the relationship between default correlation among firms and their single factor model beta parameters. Applies this relationship to compute one parameter from other. If we assume a distribution parameter b, k or pi are equal for all firms, then the probability of joint default for two firms is omega k by k minus pi square divided by pi into 1 minus pi. So this is the default correlation of any pair that we could see. So although we don't need to worry about this, but what we are saying that for each firm we have got three parameters, beta, k and pi, and once we know that, we can find out the probability of two joint defaults. The single factor model assumes that the cumulative return distribution of any pair of credit position I, j are distributed with a bivariate normal distribution and a correlation coefficient of beta into beta j. The cumulative distribution of this pair I, j is omega and is a function of aij. So we are interested in the probability of joint default that will occur in extreme tail of the distribution. This probability then is realized value of IAI is less than default threshold of critical value ki, and is denoted by a pair of credits I and j, and then we have omega, which is a function of ki, and p into ai, which will be between minus infinity to ki, and aj, which will be minus infinity to kj. So both of them are should be greater than kj, means they are not going closer. So based on that equation that we just saw, the standard deviation becomes omega ij minus omega I into omega j upon root of omega I into omega minus 1 minus omega I omega j into 1 minus omega j. So don't worry about the things here, just understand that we are trying to link the default of a company with various market parameters, and we have used three of them. We have got a default threshold, which is denoted by ki, and that is when the default would occur, or this could be a distance to default, or this could be like the distance where it should reach to actually default. So we'll get a distance to default of the company, we'll get a beta I m or ki equivalent to that, and we'll subtract that and we'll calculate the default probability of a company. Now we move to credit war with a single factor model. So explain how credit war of a portfolio is calculated using single factor model, and how correlation affects the distribution of loss severity for intermediate values of 0 and 1. Previously the loss distribution was estimated when default correlation was either 0 or was 1. In order to define distributions of loss severity between 0 and 1, we need to determine the unconditional probability of default loss. Using the single factor model framework, the unconditional probability of a default loss is equal to probability that realized market return in default loss. In other words, the individual credit asset AI are strictly a function of market return and the asset returns correlation beta with the market. The unconditional distribution used to calculate credit war is determined by the following step, and we have 4 steps here. The default loss is assumed to be a random variable x and a realized value of small x. Under this framework, x is not simulated. Given a loss level of small x, the value of market factor m is determined at a probability of the state loss level. The relationship between the loss level and the market factor return, which is x, is a function is described in m. P, or the probability of default, is k minus beta m bar upon 1 minus beta square, and omega is a function that works on this. So the market factor m bar for a loss given x bar is determined based on the same relationship. The market factor is assumed to be standard normal, therefore a loss level of 0.0199% confidence is equal to minus 2.33 on the standard normal distribution. These steps are repeated for individual credit to determine loss probability distribution. Let's try to understand with an example here and see if we can simplify this. So suppose a credit position has a correlation of market factor of 0.25. So a credit has a position has a correlation of 0.25. What is the realized market value to complete probability of reaching a default threshold at 99% confidence interval? So one thing which we can say that if you are talking about 99% interval, then we have to use minus 2.33. and at 99% confidence interval the default should be there should be a default probability of 1%. When we have both of them and we use them where k is equal to minus 2.33 minus 0.25, that's beta I into 1 minus beta square, and that will help us to get the value of m bar, which is minus 0.296. The probability that default threshold is reached is the same probability that the realized market return is minus 0.296 or lower. The parameter play an important role in determining unconditional loss distribution. The probability of default pi determines unconditional expected default for a credit portfolio. The credit portfolio's correlation with the market beta square determines the dispersion of the default based on the range of market factors. So we are trying to link everything with the market. We used input correlation of the market, 99% probability of not defaulting, and based on that we calculated this m bar, which is the default threshold. Now let's look credit VaR with copulas. So define how credit VaR can be calculated using a simulation of joint default with copula. Copula provide a mathematical approach for determining how defaults are correlated with another using simulated results. So we have four things here: define the copula function, simulate default times, obtain market values and profit loss for each scenario using the simulated default times, compute portfolio distribution statistic by adding simulated terminal values results. Now computing credit VaR with a copula. Suppose there is a credit portfolio with two loans rated CCC and BB that each has a notional value of 1 million. So if we see that there are four probabilities that one of them default or both of them default, how can we calculate a credit VaR assuming a correlation of 0.25? So the copula approach for credit VaR is applied using the following step. The first step is to simulate 1000 values using a copula function. The most common copula used for credit VaR is normal copula. The 2000 simulated values, 1000 pair results in 2000 values, and then they are mapped to standard univariate normal quantile, which results in 1000 pair of probability value. The first and the second elements of each probability are mapped to BBB and CCC default time respectively. The terminal value assigned to each loan for each simulation. The values are added up for two loans and the sum of no default event value is subtracted to determine losses. Now we have terminal value and loss for BBB default, CCC default, both default and no default. So if no default we have loss of 0, if both default we have got the highest loss and the least terminal value, and so on. The loss level sums from simulation are then used to determine VaR based on the simulated distribution. In the simulation, 99% confidence level correspond to 1.2 million portfolio loss where both loans default. The 95% level correspond to 680,000 value because 5% of the simulated will result in defaults with a total loss of 680. So this was a tricky one, although I understand, but I'll talk about simpler question that you can get here, and I think we'll be good with that. So one question that we could get here is which of the following equation best defines default correlation for the two forms of credit portfolio. So the default correlation, I'm repeating the formula, is pi 1 to minus pi 1 pi 2 upon pi y 1 minus pi 1 upon root of pi 2 1 minus pi 2. Then there is, suppose a credit portfolio is using a default coefficient framework for measuring credit portfolio. How many unique events are there for a credit portfolio with 8 different firms? So there are 256 outcome, which is 2 to the power 8. Remember we talked about 2 to the power 10, that was 1028. So if we are taking 8 firms, then there are 256 events. Suppose a portfolio has a notional value of 1 million with 20 credit position. Each of the credit position has a default probability of 2% and a recovery rate of 0. Each credit position is obligation of the same obligation, therefore credit portfolio default correlation equal to 1. What is the credit value of 99 percentile confidence interval? So with a default correlation of 1, the portfolio will act as if there is one credit. Viewing the portfolio as a binomial distribution, random variable, there are only 2 possible outcomes for a portfolio acting as one credit. The portfolio has 2% probability of total loss and 98% probability of zero loss. Therefore recovery rate is 0. The extreme loss given default is 1 million. The expected loss given is calculated is times of pi, that is 2% of 1 million. The credit VaR is the quantile of credit loss expected. So at 99% confidence interval, the credit VaR is 980 million. So we are 99% confident that the level of VaR would be equal to 98,000, which is 1 million minus 20,000 expected loss. So what is the credit value risk at 99% confidence interval? So that is 980 million. So there is a default probability of 2%. If it had been 1%, then it would have been less. Then the next question is, a portfolio manager uses a single factor model to estimate default risk. What is the mean standard deviation of the conditional distribution with a specific realized market M-bar is used? So they are asking us the value of M-bar here and how to calculate that. So the conditional distribution is a normal distribution with a mean of beta im and a standard deviation of 1 minus beta I square. So the answer here is 1 minus beta I square and the mean is beta im. Now we have the last question. Suppose a credit position has a correlation of market factor of 0.5. What is the realized market value that is used to compute probability of reaching a default threshold at 99% confidence interval? So there is a credit correlation and there is a market factor. Whenever you see market factor, you have to make sure that you are using the same. So market factor correlation is beta. The 99 confidence interval K is 2.33. So minus 2.33 minus 0.5 upon root of 1 minus 0.5 square is equal to minus 2.33, and when we calculate M bar, it comes out to be minus 62. So realized market value that is used to compute probability of default threshold at 99% confidence interval is calculated by that formula. So that would do it for this session of portfolio, or I know this was tricky, but I tried to simplify a few things for you. I hope this was helpful. Thank you. We now move to structured credit risk. We'll discuss common structured products and capital structure and securitization structure product participants, basic waterfall structure and impact of correlation. We need to understand the qualitative impact of changing default probability and default correlation for all trends. Mean, that's average, and risk, that is straightforward. Default sensitivity similar to DV01 and implied correlation from market prices. So there are different types of structured products available in the market, like convertible bonds, mortgage pass-through security, collateralized mortgage obligation, structured credit products, and asset-backed securities, and they could vary along different dimensions. Now we'll move to capital structure in a securitization. The capital structure of a securitization refers to the priority assigned to different tranches. In general, the most senior tranche at the top of the capital structure will have the highest priority to receive principal and interest. Since these securities are perceived to be the safest, they are also giving the lowest coupon. Equity tranche is the slice of the cash flow distributed with the lowest priority, which will observe the first loss up to a specified level. These securities typically do not carry a fixed coupon but receive the residual cash flow only after the security claims are satisfied. Therefore, returns are variable, and hence the term equity. The type equity tranche is the smallest part of the capital structure. Between senior and equity tranche is the mezzanine tranche, that is the junior tranche. The mezzanine tranche must absorb the losses only after the equity tranche is completely written down. Thus, senior tranches are protected by both equity tranches and mezzanine tranches, termed as subordinate or tied elements. Terminology-wise, mezzanine debt attached to the equity tranche from the above and detaches from the senior tranche from below. The junior debt claims offer a relatively high coupon or a high spread. To keep the security viable, the mezzanine tranche will be purposefully thin. There are many creative ways to provide credit portion to various security classes, but this comes at the expense of shrinking rift to other parts of the capital structure. In general, credit enhancement can be divided into internal and external credit enhancement. The term external credit enhancement means that the credit protection takes the form of insurance or wraps purchased from third party, typically a monoline insurance. Monoline insurance is an important term here. Two examples of internal credit management are over collateralization and excess spread. Over collateralization is when the pool offers claims less than the amount of the collateral. For example, MBS of 100 mortgage in a collateral pool, but the face value of bonds across the tranches is total 100 mortgage. Over collateralization is a hard credit enhancement because the protection is available at the origination of the pool. Excess spread is the difference between the cash flow collected from cash flows and the payment made to the bondholders. For example, the weighted average of the collateral is 8% net of fees, and the weighted average of the payment promised to junior senior equity tranche is 7%, and residual 1% accumulates in separate trust account. The excess spread will be invested and will be available to future shortfall. Since the excess spread is zero at the origination, it is considered as a soft credit enhancement. Now, waterfall structure. A waterfall structure outlines the rules and the condition that governs the distribution of the collateral cash flow to different tranches. In the simplest example of securitization, the senior and junior bond will receive their promised coupon conditional to sufficient amount of cash flow from the underlying loans. The residual cash flow, if any, is called the excess spread. The over-collateralized trigger will decide how the excess cash is divided between equity investor and the cumulative trust. Intuitively, the underlying cash flows will be larger in the earlier period, so the trust will build up reserve against the future shortfall. In practice, this process can be quite complex, as there may be dozens of tranches or more with different coupon maturities and over-collateralized triggers. The waterfall is further complicated by loan defaults. A simplifying assumption would incorporate a constant default rate which can be built into waterfall distribution. As loan matures, the actual incident of the loan default will increase and decrease the value of respective tranches. For example, suppose fewer loans default than the previous assumed, then the collateral cash flows are larger than expected and will benefit all cash holders, in particular the equity tranche. If we analyze a cash waterfall structure by considering a few numbers, let's try to look at that. So if we have 1000 identical loans of 1 million each, the interest rate on the floating loan is LIBOR plus 300. The senior junior tranches and equity are 80, 15 and 5%. The spread of the senior and mezzanine is 1% and 5%. There is one over collateralization trigger where the equity holders are entitled to a maximum 15% and the excess is diverted to the excess trust account. To begin with, the default rate is 0. The cash flows would be like loans are like 1000, value of loan is 1 million, principal amount is 1000 into 1 million. Then we have LIBOR, which is 5%, spread which is 3%, coupon which is 8%, default rate is 0%, OC trigger is 15,000. So over collateralization trigger, it's 15 million. So anything above 15 million is excess and diverted to the trust account. Now we have the 80%, 50% and 5% as their weightage. Now the 80% guys receive LIBOR plus 1% and the mezzanine pool will receive LIBOR plus 5% and remaining goes to the equity pool. So if the senior principal is 800,000 and the senior coupon is 6% coupon, then we will get an interest of 48 million and the mezzanine principal and the excess cash flow. So we'll have coupons for all of them, and the excess cash flow will flow to the equity amount. So anything greater than that excess cash flow will go to them. So if we get a loan proceed of like 80 million, we have to pay 48 million to the senior people, then 15% to the mezzanine tranche, and remaining 17,000. We can give only 15,000 to the equity and 2,000 will go to the trust. So that is how we are going to distribute models in the waterfall structure that we have built up. So note that senior tranche has a principal value of 800 million and the junior tranche has 150. And using a LIBOR of 5%, we have given each of them their cash flow. Next, the over collateralization test must be applied. Since the maximum of the equity tranche can receive 15%, the remaining 2 will go into the trust account. Now assume that there is a default probability of 1%. Now if default probability of 4%, then we'll get less loan proceeds. So our loan proceeds have decreased. So once our loan proceeds have decreased, the interest payment on that has decreased, and the less of interest is now going to be used for us. So that if there is a default rate of 1%, the loan proceeds become 76,800,000, and then we'll distribute them, and whatever the excess we are going to give to our remaining people. So the loan proceeds is 4%. So out of the 1 billion and 4% has default. So remaining of them will be charged 8% and will get the proceeds. Now let's understand the securitization participants. So the nature of securitization process from original loan to tranche issuer necessarily involves many different positions. The first steps begins with the originator who funds the loan. The originator may be bank, mortgage lender or other financial intermediary. The term sponsor may be used if the originator supplies most of the collateral for the issue. The underwriter performs the function similar to the issuance of the transaction debt and equity. The underwriter structures, engineers the tranche size, coupon and triggers and sells the bond to investor. The underwriter warehouses the collateral and faces the risk that the issuer will not be marked and the collateral will not drop. The credit rating agencies are an important part of securitization process. Without their explicit approval, credit rating investor be at a severe disadvantage to assess riskiness of the issue. The credit rating can influence the size of the tranches by selecting the attachment points and thus become active participant in the process. In addition, CRA may influence the issuer by required enhancement. There is a conflict of interest in the CRA who want to generate profit and grow their business, but it may come at the expense of allocating large portfolio on the capital structure to lower interest paying senior notes. Investors can alleviate this concern by performing their costly analysis and purchasing wrap-up insurance against the issue. The role of the servicer is multifaceted and possibly understated. The servicer must collect and distribute the collector cash flow and associate with, and the servicer may need to provide liquidity if payment are late and restore default simulation. It is not hard to imagine the conflict of interest in a foreclosure. The servicer would always like to delay the foreclosure to increase their fees, while the investor want as quick resolution of the possible to damage or risk maintained from those who have no economic incentive to maintain the property. When the pool is actively managed, another source of conflict arises. The manager naturally would like to minimize their efforts to continue monitor credit quality of the collateral unless he has intended to do so. A common feature of securitization pool is for the originator or the manager to bear firm's loss capital structure. So three-tier securitization structure: evaluate one or two iterations of interim cash flow in a three-tier securitized structure, including final cash flow to each tranche holder. The cash flow in a three-tier securitization, which is senior, mezzanine, equity, can be broken down into inflows from the collector and outflows to the investor. The inflows prior to maturity are the interest rate plus the recovery rate from the sale of any defined asset. Assume the collateral pool has an identical load with coupon, LIBOR plus spread. The terminal cash flow in a final year are the last interest payment plus principal and recovery of the default asset. As an additional consideration, the recovered from default would earn interest over the remaining life at a pool R. The outflows are coupon payment pays to senior and mezzanine note holders collected at and denoted as B. The equity holder position is a bit more complicated because the excess price has the first priority on the cash to provide soft credit enhancement for the more senior tranches. Specifically, include the cash flow depends on the amount of inflows less the funds diverted to the excess spread account. Now, is the current period interest sufficient to cover the promised coupon? If yes, then the following overcollateralization trust must refers to how much flows to trust. Is the current period interest sufficient to cover the promised coupon? If no, then interest is not sufficient to pay bondholders. If the shortfall is B, and the next step is accumulated funds in the spread can cover the shortfall. If trust has enough funds, then the bondholders can be paid for. The trust account does not have enough funds, then the bondholder suffers a write-down. The previous step outlined the basic feature for tranche cash flow distribution. However, the few more factors to be considered. First, for each period of possible default, simply assume default D for a constant period. Secondly, assume amount recovered T, that is 40% recovery rate, which is equal to 0.40 of the loan amount. Therefore, the total amount deposited into trust in T is R plus OC, and the following total accumulated in the trust will be R plus OC plus, and we have a geometric sum of all the amounts. So if the excess price is negative, the custodian must share. If the trust account can fill the overfall, formally the test for custodian is del is if this amount is greater than B minus L. Note that OC term is added to R since there is no excess spread period. If the above rest is true, then the trust account can make the bondholders whole. If not true, then the fund is reduced to zero bondholder and receive OC from the trust account. Using previous exposure, the amount diverted to over collateralization can be calculated, which is minimum of LT minus BK and max of LT minus B and the summation of a long term, which was the amount accumulated in the trust account in year T. Note that the upper condition inflow to the trust account, while the lower condition represents the outflow in the trust account. Finally, the equity tranche can be expressed as max of L minus B minus OC or 0. The cash flow in the final years must be examined separately for several reasons. First, the survival loan sees maturity and the principal is returned. Secondly, there is no diversion to the trust account because the structure ends and all proceeds go to waterfall. Third, since there is no diversion to the trust, there is no need to test to overcollateralize trigger. The term cash flows are summarized as loan interest, proceeds from surviving, recovery in final year, residual in trust account. The sum of those terminal cash flow is compared to total amount due in the senior tranche. If the sum is large enough, the senior tranche is paid off and the remainder is available for the capital structure. If the remainder is large enough to convert junior tranche, the residual flows to equity. If the remainder cannot make junior cap, then the junior bond receive excess and equity holders receive nothing. Now let's look at an example to understand this, and then we'll look at some qualitative aspect of the simulation approach. So let's determine the terminal cash flow to a senior junior tranche. The original term is 100 loans with 1 million and a fixed coupon of 8%. The number of surviving loan is 90. The par for senior junior tranche is 75 and 20. The equity investor contributes remaining 5%. The default rate and the recovery rate is 40%. There were two defaults and recovery rate was 40%. The value of the trust at the beginnings was 16 million and earning was 4 million. So we are trying to look at what will happen at the end. So total size of collateral is 100 into 1 million, that is divided into senior tranche. Interest from the loan is like 19 to 8% into 1 million, and redemption at par is 19 to 1 million. Recovery in final year would be like 40% of 1 million into 2, the value of OC at the end over collateralization, which would be 16 into 1.04, and the total available to satisfy the claim then will pay off to everybody using this money. So and that would depend on how everybody would receive everything. Now let's look at simulation approach, and there are chances to get questions more from here. Describe the simulation approach to calculating credit losses for different tranches and securitization of portfolio loans. The prior analysis was made using very important assumption, but those assumptions were very simple. In particular, the analysis assumed that default rates were constant overlay and each loan exhibit the same probability of default. The correlation between the default was ignored. In practice, these assumptions need to be brought down into analysis, and in a tractable ways to do is using simulation. All the technical details we are not going to look at right now, but what we are looking at are 3 steps. Estimate the parameters, generate default time simulation, and compute portfolio credit losses. The first step is to estimate the critical parameters, default intensity and pairwise correlation. The default intensity can be estimated using market spread data to infer the hazard rate across the various maturities. This piecewise bootstrapping methodology to construct the cumulative default distribution. Estimating the correlation is more challenging because lack of usable market data. The Coppola correlation should be used in theory but suffers from empirical precision in practice. Instead, a sensitive analysis is performed by using various defaults and correlations pairwise. Okay, the second step identifies if when the security is default. Simulation provides information on timing for each hypothetical outcome. The third step uses simulation output to determine frequency and timing of credit losses. The credit losses can be lined up to access the impact of capital structure. The tail of the distribution will identify credit worth for each tranche in the securitization. Then we have impact of probability of default and default correlation. Now we need to understand how the probability of default and default correlation among the underlying asset requirements affect the value, losses and credit worth of equity junior and senior tranches. There are several important comparative statistics associated with general securitization, and we'll look at some of the results that affect average tranche and write-downs. The implication of extreme tail events which needs to be taken care of. The first factor to consider is the probability of default. It is straightforward to see that for a given correlation, increasing the probability of default will have a negative impact on cash flow and thus the value of all tranches. The effect of changing the correlation is more subtle. Consider a stylish case where correlation is very low, say 0, so the loan performance is independent. Therefore, in large portfolio, it is virtually impossible for loans to default and is unlikely that there will be a number of defaults. Rather, numbers should vary close to probability of default times the number of loans. So the pool will experience a level of default very close to mathematical calculation is unlikely to impair senior tranche. The analogous simulation is flipping 1000 coin. The number of heads would be very close to 500. It would be for a number of heads to be less than 4 or greater than 600. Now if the correlation increase, the default of one credit increase the likelihood of the default of other. Thus increasing correlation decreases the value of the senior tranche as the pool is more likely to suffer from extreme losses. This effect is exacerbated with higher probability of default. Now consider equity tranche. Recall that equity tranche suffer from first write down in the pool. Therefore, a low correlation implies predictable but positive number of defaults. In turn, equity tranche will suffer assuredly write downs. On the other hand, if correlation increases, the behavior of pool is more extreme and there may be high level of related losses, or there may be few loan losses. And some equity tranche increases in value from increasing correlation as the possibility of zero credit loss increases from high correlation. The correlation effect on mezzanine tranche is more complex. When default rates increases, the correlation increases the likelihood of losses to the junior tranches However, when defaults are relatively high, increasing the correlation actually decreases the expected loss to the bonds, and few default is more likely. According to mezzanine bond mimics the return pattern of equity tranche. In short, increasing correlation at low rates decreases mezzanine bond value. Just remember this: increasing correlation at low default rates decreases mezzanine bonds, but at high default rates it will increase mezzanine bond values. So this is again a tricky thing to understand. I repeat what we did for equity. So the equity tranche increases in value from increases in correlation, as possibility of zero credit losses increases from high correlation. So if the correlations are high, then equity tranche value will be higher, but the default should be low. So in that case, equity tranche is happy. Convexity is also issue for default rates for equity investor. As default rate increases from low level, the equity tranche decreases rapidly than modality, a characteristic of positive convexity. So equity tranches change small change in default rates which disproportionately impact bond prices at first. Similarly, senior tranche exhibit negative convexity. As default increases, the decline in bond price increases. As usual, the mezzanine impact somewhere is between negative convexity at low default level and positive convexity at high default. So that was it about the equity tranche. In the previous section we focused on average mean of the tranches, while we should now look at the distribution of possible risk or possible tranche values. Specifically, the goal is to analyze the impact of default probability and default correlation under extreme scenario, far into the tail. The metric used is credit war for single range of default probability and default correlation for senior junior equity tranches. The main result is that increasing default probability while holding correlation constant generally decreases the VAR for equity tranche, less variation in return, and increases the VAR for senior tranche, more variation in return. As usual, mezzanine tranche is mixed, VAR at low levels like senior bonds, then decreases at high levels like equity. I want you to look at this very carefully. We are saying that we are using default probability and default correlation, and when we increase default probability while holding correlation constant, so it means that default probability is increasing but the correlation is constant. So everything is not going to default, but here and there things are default. Generally decrease the VAR for equity tranches because there is less variation in result, and increases the VAR for senior tranches. So we should have less loss for equity if we are increasing default probability but correlation is constant. One reason for here is that if we are not correlated, we have already taken a lot of things into account. So this is good for equity if the default probability is high, because we are going to take this into account beforehand. But if there is correlation, and the effect would be magnified then. So just remember this thing, that the main result is that increasing default probability while holding correlation constant generally decreases the VAR for equity tranches and increases the VAR for senior tranches. And the mezzanine effect is mixed, VAR at low default levels like senior bond, and decreases at high default level like equity bonds. So you need to understand that and I am again repeating of what we talked at. So in the last section, the equity tranche increase in value from increasing correlation, as the possibility of zero or few credit loss increases from high correlation. So the equity tranches increases value from increasing correlation as the possibility of zero credit losses increases from high correlation. So if we have defined a probability and we increase the correlation, which means that there is a lot probability that nothing is going to happen, because every bond is linked up and the probability of default is very low. So when we increase the correlation and kept probability of default constant, then what we were observing was that equity tranche was increasing in value. Now what we are doing is that we are increasing default probability while holding equity, while holding the correlation constant, and this is decreasing the VAR of the equity branch, and this is again mixed up for the mezzanine tranche. Now the effect is raising correlation. As a reminder, increasing correlation, increasing clustering events, either high frequency of default or very low default. Increasing correlation decreases senior bond prices as subordination is more likely to breach default in the cluster. In contrast, returns increases as low default scenario is more probable for equity. As the default correlation approach 1, equity war increases steadily. The interpretation is that although the mean return is increasing, so risk return is more variable. So if the default correlation approach 1, the equity war increases steadily. The interpretation is that although mean return is increasing, so is the risk is more variable, large losses or small losses. All else equal, senior war also increases consistently with correlation. We here note that increasing effect, the incremental difference from high correlation 0.6 to 0.9 is relatively small. In addition, pairwise results are worthwhile highlighting. If correlation is low and default probability is high, the senior bonds are well insulated. So if the correlation is low and default probability is relatively high, the senior bonds are well insulated. In fact, 10% subordination level senior bond would earn effect at high level rate. At the other extreme, if the correlation is high, 0.6 or above, then war is quite similar regardless of default probability. Hence, generally speaking, correlation is more important risk factor than default probability, which may not be intuitive at times. The implication for mezzanine is mixed. So let's move to the next topic, which is measuring default sensitivities. So in the previous discussion, we looked at the effect of increasing probability of default, which decreases trench values. However, this effect is not necessarily linear and also depends on the iteration with default correlation. To analyze the marginal effect in more detail, the definition of division is extended to default probability and known as default 0-1. The default probability will be shocked up and down by the same amount by conventions of 10 basis points, with each trench will be revalued through war simulation. So 1 by 20 by loss value on pi plus 0.001 minus mean by loss on pi 0.001. So there is an equation, a formulation of default 0-1 for a tranche, which uses 1 by 20 mean loss upon loss based on pi 001 minus mean value upon loss based of probability of default 0.001. I really don't understand because they have not given any explanation here, but let's look at the description. From this equation, there are several qualitative impacts to note. First, the default sensitivities are always positive for any default probability correlation combination. This follows from previous observation that all tranches are negatively affected from increasing default probability. Secondly, the default 0-1 will approach 0 as default rates become sufficiently high, as the marginal impact of increased rate has minimum effect. Third result follows from the second. There will be more variation in the default sensitivities when the default rate losses close to tranches attachment point. This results in similar high gamma or high delta position as at the money. So I'll now move to some of the questions that we can see here. So before I move, I'll quickly talk about some summaries. Loan originators help create securitized by selling loans into a trust. They are attracted to secure borrowing by securitization because it provides lower cost of funding than alternatives such as retaining loans. Investors purchase the bond and equity in a securitization. They are attached to securitization because it allows them to invest in diversified pools than typically reserved for bank. Implied default correlation for each tranche can be backed out of the money tranche model, similar to how implied volatility is calculated for Black-Scholes-Merton model. So implied default correlation for each tranche can be backed out the tranche pricing model as the way in which we did for Black-Scholes-Merton model. Similar to equity portfolio, systematic risk is present in credit portfolio. Extreme loss events are captured by high default correlation. The thinness of equity and mezzanine tranche implies that conditional losses are likely to be large. A less granular pool, fewer but large one, is more likely to experience a tail event, all else equal. Now let's look at some of the questions that we could get. The first question says, which of the following statement describes the implied correlation? So starting with observed market prices and pricing function for the tranches, it is possible to back out the implied correlation to calibrate the model price from the market price. The computation of implied correlation assumes constant pairwise correlation. Both credit default swap and tranche value are observed. Observed tranche values are used in conjugation with risk neutral default to compute implied correlation. The next question is, which of the following statement about portfolio losses and default correlation are correct? So increasing default correlation increases likelihood of more extreme events. The increasing likelihood of high default negatively impacts the senior tranche. On the other hand, increasing likelihood of few default benefits the equity tranche as it bears the first loss. Now at high default rate, increasing the correlation increases the likelihood of more extreme events which benefits equity investors and mezzanine investors. Then we have which of the following participate in the securitization pool is least likely to face a conflict of interest. So who will not face a conflict of interest? So custodian and trustee play the least important role in securitization. So they will not pay. And the servicer, originator, underwriter, credit rating agency, manager all faces conflict of interest to varying degree. Then we have how many of the following statement concerning the capital structure securitization is correct. So I'll read only the right one. Senior tranches are perceived to be safest, so they receive lowest coupon. The equity receive residual cash flow, no expiry option. Although mezzanine tranches is often thin, the equity tranche is typically the thinnest slide. Okay, now I'll move to a little trickier question. So assume there are 100 identical loans with a principal of 500,000 each. Based on credit analysis, 300 basis point spread is to applied. LIBOR is 4%. Coupon will reset annually. The senior junior tranche are 75-25%. The spread of the senior is 2% 6%. Excess cash flows is diverted about 1,000. Assuming default rate to be 2%, what is the cash flow to the mezzanine and trust flow? So we did it. So we first find out the interest rate, then the total cash flow that we should get, and we subtracted from it the default probability. Then we calculated what money that we are going to give to senior tranche, mezzanine cash, and the residual cash flow to the equity branch, and there is a maximum cap to that, and the rest of that goes to the trustee account. So that what is for the credit risk. I hope this was helpful. Let me know if you need any help.